Securitization. So, introduction to securitization. The concept of security in bank management means it's a financial claim in a document form that is marketable. So, that is basically the first steps in securitization. We know that banks give loans or credit card to obligors or the bank's customers, and as part of it, bank also has assets in the form of loans and credit cards. Now what happens in securitization is that there is SPV, which is a trust which is formed, which is special purpose vehicle, which basically buys the bank's assets. So what are bank's assets? Bank's assets may be loans or credit cards which they offer to bank's customers. So these loans and credit cards, for example, are bought by the special purpose vehicle, which is a trust formed as a result of banks in the trust or other companies, and they make financial instruments based upon the assets of the banks which it actually sells to the SPV. So these financial instruments will again be bought by the investors, which would mean the investors can now get the payments, the repayments which is made by bank's customers or bank's debtor or obliger directly or through the SPV. The investors can actually buy those assets of the banks, not exactly assets, the cash flow or the money which goes into the investor. So the banks can actually buy that. So this is the basis of securitization. We'll explain it a little bit more in detail so that the concepts are understood well. So first is that the concept of security in bank management means it's a financial claim in a document form that is marketable. And hence securitization is a concept where it is concerned with an array of conversions of non-marketable assets. So what are these non-marketable assets? These are loans or credit cards which a bank actually gives to its customers or debtors. So those becomes assets of the banks, and those assets are actually the non-marketable assets for a bank in the form of existing assets or future cash flows. Credit card is a cash flow. Loan is not a cash flow, but it is an asset of the bank, because bank gets the repayments, principal and interest from the obliger or the bank's customer who has taken a loan from the bank. Now, conversion of an existing asset, which is a non-marketable asset, into marketable securities is known as asset-backed securitization. So, as I was explaining, some of the examples are car loans or housing loans. Again, conversion of future cash flows, which is a non-marketable asset, into marketable securities is known as future flow securitization. Some of the examples are credit card payments and car rentals. Now, in addition, so we were mentioning that the SPVs, after buying the bank's assets, which is loans or credit card payments or anything like that, they make financial instruments. So what are some of the financial instruments? They are pass-through certificates, PO certificates, IO securities, PAT. So these things we will explain it later, but these will be again bought by the investors, and through which it's an instrument through which the investor can get the principal and interest payments of the bank's customer, because these assets are bought by SPV, and SPV makes these financial instruments work for the investor. Now let us take a look at what is securitization process, which are basically the different roles which we actually try to discuss. So we know that the banks provide loans to the borrowers based on the credit worthiness of the borrowers. Borrowers of loans from banks repay principal and interest based on the tenor of the loan, which may be short term, which is for 1 year, or long term, which is for more than 1 year. So for the bank, the loan is an asset and the outstanding portion of the loan is placed in the balance sheet of the bank. However, for banks, once the loans are given out, a huge portion of its funds are blocked, and the bank has to raise additional funds from the market to meet its fund requirement or provide for additional loans. So the bank has to basically get those money from the market. Now, how do they do it? It is through the method of securitization. So this is made possible by securitization, which helps the bank to unlock these blocked funds. The process is explained as follows with the help of the role played by different or aligned functionaries in the securitization process. So while discussing roles, we will first see what is the role of an originator, which is the bank itself. Next is the role of special purpose vehicle or SPV, the role of splitter of securities, which is also SPV, the role of payer of securities, which must be the obliger or the bank's customer who pays interest and principal to the loans which that person has taken from the bank. And we also have credit rating, which is the credit rating agency, which basically fulfills that role, which is the credit rating agency. And then we have investors. So that is basically the different roles which are there in the securitization process. So we will go through each and every role and then basically explain what those roles mean in the securitization process. So the role of originator. The bank or the financial institution that wants to securitize its non-marketable asset, which may be loans or credit card payments, etc., play the role of the originator and segregates loans, leases and receivables into pools with a homogeneous risk that falls into different risk categories, namely credit, maturity and interest rate risk. So that is basically the role of the originator, which is the bank themselves, who has assets in the form of loans or credit card payments or anything like that, and then sells these assets to the SPV or special purpose vehicle. So that is the next role, which is SPV or special purpose vehicle. Now what does it do? So SPV is usually constituted as a trust to which the pool of assets formed by the originator is transferred. SPV may be floated jointly by the originator or individuals or banks or institutions, merchant bankers, or maybe a subsidiary in the form of a limited liability company that is interested in the deal of securitization. Now what is the next role? It is splitter of securities. What does that role do? So this role is also played by the SPV, where various assets are split by the issue of pass-through securities or pay-through certificates, which are a form of debt securities of beneficiary ownership, according to the maturity date and interest rate, with or without recourse. We'll explain what is pass-through certificate soon. Now, that is the role of splitter of security, which is again committed by the or which is again fulfilled by the special purpose vehicle. Now, what is the next role? It is payer of securities. So, who is the payer here? Payer is nothing but the obliger or the bank's customer who has taken loans or credit cards from the bank. Now, this role is played by the obliger, one of the three fundamental participants of the security transactions. The obliger, who is the originator's debtor, bank's customer in other words, who has taken a loan, let us say principal and interest on the loans, leases and receivables in the underlying pool of the bank's asset, which are actually collected by the servicer, and it will be passed to the investors through the SPV or through this pass-through certificate, which we will explain later. So next role is credit rating agency. This pass-through certificate or pay-through certificate, which I was mentioning about, is rated by a credit rating agency and when issued to the public can be traded in the secondary market as debt instrument for an interest rate swap. So this completes the different roles in the securitization process. Next, we will see who are the participants in the securitization transaction. So as explained, the three main participants in the securitization transactions are bank, who is the originator, who has loans and credit cards to its customers, or in other words, who has those assets, which it sells it to the next participant, which is SPV or special purpose vehicle, who makes financial instruments out of it, which will be sold to the investors, or investors invest money in them and get what is called as the future of cash flows, or principal and interest payments from the obliger. So obliger in turn of, in basically in place of giving the money to the bank, those interest payments and principal may give it directly to the investors. So that is what happens in the securitization process. So the main participants are bank, SPV and the investor. Now the investor, who could be individuals or qualified institutional buyers like financial institutions, mutual funds, pension funds, insurance corporations, etc., who may buy a participating interest in the pool of assets and receive this payment in the form of principal payments or interest payments from the obliger as per an agreed pattern collected by the servicer. Now, so these are the main participants. So always remember, main participants of the securitization process are bank, special purpose vehicle and investor. Now we have other participants. Who are they? The obliger, the payer actually. Obliger or the bank's debtor is another participant. Underwriter is another participant. Credit rating agency is another participant, and credit enhancer is another participant. So let us see what each of these participants do very briefly. Okay, obliger or the bank's debtor, bank's customers who have taken a loan or credit card from the bank, make periodic payments in the form of principal and interest to the bank's loans, which are assets of the banks that get transferred to the SPV. Remember, these assets of the banks are sold to the SPV. That is why whatever the obliger pays in principal or interest directly goes to the investors through the SPV by way of financial instruments. So that much you have to understand. Next is the underwriter. What does an underwriter do? Underwriter is a participant. The underwriters are employed to underwrite the different types of securitization instruments to the investors. So we will explain also the different types of securitization instruments later. Now next participant is credit rating agency. So the rating agency assesses the process of selection of loans of appropriate credit, liquidity support provided, as well as legal framework that these banks' assets are imbibed in. So that is a rating agency. And the last participant is credit enhancer. There may be other participants also. Servicer is one participant, but credit enhancer is another participant, where underwriters take help from external credit enhancers who may improve the instrument's credit profile. So there exist various types of credit enhancers and are experts in the field of third-party guarantees and letters of credit. So these are basically the different participants in the securitization process. Remember, the main participants are bank, SPV and investors, and other participants are obliger, underwriter, credit rating agency and credit enhancer. Next, we will take a look at some of the securitization instruments. So what are they? There is pass-through securities, principal-only securities, interest-only securities, and planned amortization tranches. So these are the different securitization instruments. We will briefly see what they are. In pass-through securities, so these securities are again made by the SPV or the special purpose vehicle, and it is sold to the investors. So this pass-through security, what it is, also called participation certificate in the underlying pool of originators' assets, it represents direct ownership of the investors. Periodically, payment of the principal and interest made by the obligers are collected by the servicer and passed on to investors. So in this type of security, there is no modification of cash flow. So that is pass-through security or PTC. Now what is principal-only security or PO? PO investors receive principal payments made by the obliger of the underlying loans. So these bonds are issued at deep discount. We have to see deep discount bonds to understand how the mechanism works. So these bonds are issued at deep discount to their face value and redeemed at face value. So that is principal only security. Next is interest only security or IO. The interest component of the underlying loan is received by the investors. Principal won't be there. It will be only interest component of the underlying loan is received by the investor. The securities have no par value or face value, and as the principal is repaid, its cash flow diminishes. So that is basically IO security. Now last is planned amortization tranches or PAC, which is actually a sinking fund. Principal sinking fund is created beyond a certain band. The principal sinking fund takes care of prepayments. So that is basically planned amortization tranches. So these are some of the securitization instruments which are basically sold to the investors, and they receive payments from the obliger, maybe in terms of principal and interest or fund flow, etc. Lastly, we'll see what are the benefits. So there are benefits for originator bank and there are benefits for investors. So to the originator bank, what are the benefits? It provides a lower cost of borrowing, improves financial indicators, and is a source of liquidity. It also provides ALM, which is asset liability management. There's a separate section on that which is already available. You can take a look at what exactly is ALM. So the benefit to the originator bank is it also provides, securitization provides ALM and diversified fund sources. And to the investors, what is the benefit? The securitization provides a new asset class. Risk diversification is attained and customization is made possible for investments, as well as there is a complete decoupling with the originator made possible in this type of arrangement. So we have covered basically the basis of the securitization concepts of how it works. Thanks.